Global financial markets experienced a significant downturn in early April 2025, marking the most severe crisis since the COVID-19 pandemic. The S&P 500 fell by 6%, the Dow Jones Industrial Average dropped 2,231 points, 5.5%, and the Nasdaq Composite declined by 5.8%. This turmoil was primarily driven by escalating trade tensions between the United States and China. In response to U.S. President Donald Trump's imposition of a 34% tariff on Chinese imports, China announced equivalent retaliatory tariffs on all U.S. imports, intensifying fears of a global trade war and potential recession. Despite a robust U.S. jobs report indicating stronger than expected hiring, these concerns overshadowed positive economic indicators. The market reaction was swift and severe, with major indices experiencing substantial weekly losses. The S&P 500 down 9.1%, the Dow down 7.9%, and the Nasdaq down 10%. Year-to-date, the S&P 500, Dow and Nasdaq have declined by 13.7%, 9.9%, and 19.3%, respectively. The Russell 2000 index, tracking smaller companies, also fell by 4.4% for the day and 9.7% for the week, reflecting broader market anxiety. The trade tensions have also affected commodity prices, with crude oil reaching its lowest level since 2021 and copper prices falling, signaling concerns over weakened global economic growth. Companies with significant exposure to China, such as DuPont and GE Healthcare, faced sharp stock declines, with DuPont under antitrust investigation by Chinese regulators. Federal Reserve Chair Jerome Powell expressed caution regarding the potential inflationary impact of tariffs, suggesting limited room for interest rate cuts. The Fed is in a challenging position, balancing the need to stimulate the economy against the risk of fueling inflation expectations. As the situation remains fluid, investors are closely monitoring any signs of negotiation or resolution that could stabilize markets and mitigate the risk of a deeper economic downturn.
Chevron has been ordered to pay over $740 million in damages to restore coastal wetlands in southeast Louisiana, following a landmark trial that sets a significant legal precedent in environmental accountability for oil companies. This ruling, originating from a lawsuit filed by Plaquemines Parish, holds Chevron liable for the environmental degradation caused by Texaco, which it acquired in 2001. The jury found that Texaco violated Louisiana's coastal regulations by failing to restore wetlands impacted by operations such as dredging canals and improper wastewater disposal. The damages include $575 million for land loss, $161 million for contamination, and $8.6 million for abandoned equipment, with the total potentially exceeding $1.1 billion when interest is considered. This case is the first among many pending lawsuits against major oil firms for their roles in accelerating land loss and environmental degradation along Louisiana's coast, where over 2,000 square miles of land have disappeared in the past century. The verdict underscores the mounting legal and financial pressures on the oil industry to address historical environmental impacts, potentially paving the way for billions in liabilities for similar cases. Chevron plans to appeal, arguing that the law should not apply retroactively, and that other factors, such as the Mississippi River's levee system, are primarily responsible for land loss. Despite these defenses, the ruling emphasizes the urgent need for environmental restoration and could prompt other companies to seek settlements as Louisiana aims to fund its coastal restoration initiatives amidst financial challenges. This decision highlights the tension between economic reliance on the oil sector and the necessity for environmental conservation in a state vulnerable to extreme weather and rising sea levels.
Big bank stocks, including JP Morgan Chase, Citigroup, and Goldman Sachs, have experienced significant declines following President Trump's recent tariff announcements. The stocks of these financial giants fell by 7.48%, 7.8%, and 7.91% respectively. The market reaction reflects investor concerns about the broader economic implications of increased tariffs, which could dampen economic growth and impact the financial sector's profitability. Tariffs, essentially taxes on imported goods, can lead to higher costs for businesses and consumers, potentially slowing down spending and investment. The announcement has introduced volatility into the financial markets, with banks being particularly sensitive due to their exposure to economic cycles. As major players in the global financial system, these banks could face challenges in their international operations and trading activities, as tariffs can disrupt global supply chains and trade flows. The decline in bank stock prices also signals a cautious sentiment among investors, who may be repositioning their portfolios in anticipation of further market disruptions. The impact of these developments extends beyond the banking sector, as tariffs could have a ripple effect on various industries reliant on global trade. Analysts and economists will be closely monitoring the situation to assess the long-term effects on economic growth and financial stability. Investors are advised to stay informed on policy changes and market reactions to navigate the evolving landscape effectively.
Apple Inc., AAPL, is currently experiencing significant market volatility following the announcement of new trade tariffs by President Donald Trump, which he dubbed Liberation Day. These tariffs, aimed at addressing the U.S. trade deficit, were more severe than anticipated, causing a ripple effect in global markets and contributing to heightened volatility. This turbulence has led to a notable spike in the VIX, also known as the Fear Index, reaching its highest level since August 2024. Despite the immediate market turmoil, historical data suggests that the S&P 500 often delivers above-average returns after such volatility spikes, indicating potential long-term buying opportunities. However, Apple is on the brink of a technical event known as the death cross, where its 50-day moving average falls below the 200-day moving average, typically signaling a potential downtrend or bear market. Historically, Apple has shown a tendency to recover in the months following a death cross, with an 80% success rate of price increases within 3 months to a year. Yet the short-term outlook remains uncertain, as Apple's stock has only risen once in the month following previous death crosses. As a result, traders are advised to exercise caution, with some considering option strategies like bear put spreads for short-term gains, while others may opt for bull call spreads to capitalize on potential rebounds in the coming months.
Maxion Solar Technologies has announced a strategic shift to focus exclusively on the U.S. market as part of a broader restructuring initiative. The company has sold its non-U.S. assets for approximately $94 million to streamline operations and capitalize on the growing demand for solar energy solutions in the U.S. This move aims to enhance Maxeon's presence in the U.S. residential, commercial, and utility power plant markets by improving supply chain resilience, operational efficiency, and cost reduction. CEO George Guo highlighted these changes as crucial for long-term growth in the competitive solar industry. However, Maxeon is currently facing regulatory challenges with the U.S. Customs and Border Protection (CBP) over the detention of its solar panel shipments under the Uyghur Forced Labor Prevention Act (UFLPA). Despite providing extensive documentation to demonstrate compliance, CBP has denied Maxeon's protests, citing insufficient documentation. This decision has created uncertainty for Maxeon and its clients, impacting U.S. commerce and energy goals. In response, Maxeon is exploring alternative manufacturing and supply chain strategies that are not affected by the CBP's decision, and plans to challenge the ruling at the U.S. Court of International Trade. Maxeon remains committed to its environmental, social, and governance (ESG) practices and transparency. The company is advancing its domestic manufacturing capabilities, particularly through the development of its Albuquerque-based facility, which will incorporate next-generation technology to support domestic production and mitigate the impact of new tariffs and trade barriers, while aligning with U.S. energy objectives.
The Rosen Law Firm has announced a deadline for investors who purchase securities of FMC Corporation, NYSE FMC, between November 16, 2023 and February 4, 2025, to apply for lead plaintiff status in a securities fraud class action lawsuit. The lawsuit alleges that FMC Corporation made false and misleading statements regarding its channel management initiatives and pricing strategies, leading to inflated inventories in key markets such as Latin America, Asia, Canada, and Eastern Europe. As a result, the company's positive outlook on its business operations was deemed materially misleading, causing investor losses when the true details emerged. The significance of this lawsuit lies in its potential financial impact on FMC Corporation and its shareholders. If successful, the class action could result in substantial financial compensation for affected investors. This legal development may also influence FMC's stock price and market perception, as ongoing litigation often brings uncertainty and potential reputational damage. Investors interested in participating in the class action or serving as lead plaintiffs should act by the April 14, 2025 deadline to ensure their involvement in the case.
Sea Limited, a leading Southeast Asian e-commerce and digital services company, experienced a significant 11% drop in its stock price, with a total decline of 16% over the week. This downturn follows the announcement of new U.S. tariffs targeting countries in Sea's operational region. Despite the tariffs not directly affecting Sea's business, the market's reaction appears to be more about broader volatility and profit-taking, as the company's stock had previously doubled over the past year due to robust performance. In 2024, Sea Limited reported impressive financial results, with a 29% increase in revenue and a near tripling of net income. The growth was well distributed across its three main business segments: e-commerce, Shopee; digital financial services, Sea Money; and digital entertainment, Garena. Notably, each segment achieved positive adjusted EBITDA, contributing to a 66% rise in overall adjusted EBITDA. Sea's strong cash position of approximately $10 billion supports its continued expansion, especially in Brazil, where its e-commerce user base grew by 40% and its lending unit increased its loan principal by 60%. With a forward earnings multiple of 27.9, Sea's stock presents an attractive opportunity for investors, given its substantial growth prospects.
China Pharma Holdings Inc. has announced a 1-for-10 reverse stock split set to take effect on March 6, 2023. The move, approved by the company's board of directors and stockholders, will see every 10 shares of the company's common stock consolidated into 1 share. This adjustment aims to increase the stock's market price and improve its appeal to investors, while maintaining the company's listing on the NYSE American under the symbol CPHI. Importantly, the reverse split will not alter any stockholders' percentage ownership in the company, except for minor adjustments due to the rounding up of fractional shares. The reverse stock split is a strategic decision by China Pharma, a specialty pharmaceutical company focused on high incidence and high mortality conditions in China. By consolidating shares, the company may aim to enhance its stock's marketability and potentially attract a broader range of institutional investors who may have minimum price thresholds for investment. This move comes amid a challenging economic environment in China, with potential impacts on market demand and competition. The company's future performance will depend on its ability to navigate these challenges, as well as its success in new product development and expansion of its distribution network.
The recent press release highlights the competition among altcoins MagaCoin Finance, Pepe, and XRP as they vie for dominance in the 2025 crypto market. MagaCoin Finance is positioned as a standout contender due to its focus on solving real-world problems, offering scalable and secure solutions beyond the typical meme coin hype or the established payment solutions provided by XRP. The pre-sale of MagaCoin Finance is gaining significant attention, suggesting strong investor interest due to its potential for long-term growth and applicability across various industries, including decentralized finance, DeFi, and tokenized assets. Pepe, known for its meme-driven appeal, has captured the interest of a dedicated community, but faces challenges in sustaining long-term growth due to the inherent volatility of meme-based investments. Meanwhile, XRP remains a strong player in the blockchain space, particularly for financial institutions focused on cross-border payments. However, its scope is somewhat limited compared to MagaCoin Finance's broader applications. As the crypto landscape evolves, MagaCoin Finance's versatility and strategic focus on addressing contemporary digital finance needs position it as a formidable option for investors seeking substantial returns.
Williams Companies WMB has recently caught the attention of significant investors, evidenced by unusual options trading activity. Over the past 3 months, there were 10 notable trades, with a mix of bullish and bearish expectations. Specifically, 8 put options totaling $434,943 and 2 call options totaling $269,576 were identified. Investors appear to be targeting a price range between $40 and $60, which indicates a strategic positioning in anticipation of future price movements. The average open interest for Williams Companies options is 5,967.5, with a total volume of 13,313.00, reflecting robust investor interest. The company, a major player in the midstream energy sector, operates key pipeline systems and natural gas assets. Analysts have mixed views on its stock, with Morgan Stanley maintaining an overweight rating and a $70 target price, while Scotiabank and Barclays offer more conservative targets of $53 and $58 respectively. This divergence in analyst opinions, coupled with the unusual options activity, suggests varying expectations about the company's future performance. As the market continues to react to these developments, investors are advised to monitor analyst ratings and options market signals closely for potential shifts in Williams Company's stock trajectory.
Grayscale Investments has announced a rebalancing of its multi-asset funds for the first quarter of 2025, reflecting changes in the weightings of various digital assets within its portfolios. This adjustment affects several of Grayscale's products, including the Digital Large Cap Fund, GDLC, the Decentralized Finance Fund, DEFG, the Smart Contract Fund, GSC, and the Decentralized AI Fund, AI Fund. The rebalancing is conducted in accordance with methodologies set by CoinDesk indices, which guide the proportional buying and selling of existing fund components. Notably, the GDLC fund now holds Bitcoin 79.59% and Ether 10.54% as its largest components, while the DEFG fund's largest holdings are Uniswap 42.75% and Aave 27.44%. The rebalancing reflects Grayscale's strategy to align its funds with the evolving digital asset market landscape, ensuring that its investment products accurately represent market capitalizations and liquidity of underlying assets. Such periodic adjustments are crucial for maintaining the relevance and performance of these funds in a rapidly changing market. The removal of Near Protocol from the Smart Contract Fund and LivePeer from the AI Fund indicates a strategic shift in focus or performance expectations for these assets. These changes could influence investor sentiment and potentially impact the trading prices of the affected cryptocurrencies, given Grayscale's significant presence in the crypto investment space. Overall, these adjustments underscore the dynamic nature of digital asset investment and the importance of strategic fund management in capturing growth opportunities and mitigating risks. Investors in Grayscale's funds should be aware of these changes, as they may affect the value and performance of their holdings, especially in a market characterized by high volatility and rapid innovation.
Green Power Motor Company Inc. has announced its 2025 Annual General and Special Meeting of Shareholders, scheduled for May 23, 2025. This meeting is crucial for the company as it addresses compliance issues with NASDAQ's Listing Rule 5620A, which mandates holding an annual general meeting within 12 months of the fiscal year end. Green Power received a notification of non-compliance from NASDAQ on April 1, 2025, but expects to rectify this by conducting the meeting as planned. This development is significant for shareholders and potential investors, as it impacts the company's standing on the NASDAQ exchange and reflects its commitment to regulatory adherence. Green Power, a prominent player in the electric vehicle sector, specializes in producing zero-emission medium and heavy-duty vehicles, including transit buses and school buses. The company's strategic focus on clean energy transportation solutions positions it well within the growing market for sustainable transport. This meeting will likely cover future strategic directions, financial performance, and governance issues, offering insights into the company's operational priorities and market positioning. As Green Power continues to expand its footprint in North America, maintaining compliance and transparency with regulators is essential for sustaining investor confidence and supporting its growth trajectory.
Edessa Biotech, a clinical-stage biopharmaceutical company listed on NASDAQ, EDSA, and specializing in immuno-inflammatory disease therapeutics, has announced the appointment of Peter J. Weiler as the new Chief Financial Officer, effective May 1, 2025. Weiler will replace Stephen Lemieux, who is stepping down to pursue other opportunities, but will remain as a financial advisor to the company. Weiler's extensive experience in finance and corporate strategy, gained from his previous roles at XL Pharma, Bioscient Inc., and Cipher Pharmaceuticals, is expected to be instrumental as Edessa advances its drug pipeline and explores strategic opportunities. The company is currently focused on developing treatments for medical dermatology conditions, such as vitiligo, with its candidate EB06, and respiratory conditions like acute respiratory distress syndrome, ARDS, and pulmonary fibrosis, with its candidate EB05. Edessa has secured governmental support for its respiratory programs, underscoring the potential impact of its developments on public health. Additionally, the company recently raised $15 million through a private placement to support its CXCL10 antibody program. This leadership transition comes at a crucial time as Edessa seeks to capitalize on its clinical advancements and secure regulatory approvals, which could significantly influence its market position and financial health. The market will be closely monitoring how Weiler's appointment impacts Edessa's financial strategy and execution, particularly in navigating the complexities of drug development, securing capital, and commercializing its therapies.
CV Holdings, Inc. reported a net loss of $18.15 million for the fiscal year ending December 31, 2024, translating to a loss of 28 cents per common share. This marks an increased loss from the $15.96 million, or 25 cents per share reported in 2023. The primary contributors to this financial downturn include significant interest expenses on preferred equity, totaling $14.46 million, credit loss expenses of $8.95 million, and interest on lines of credit and securitized debt amounting to $8.72 million. Additional operational costs, such as $7.60 million in salaries and related payroll expenses, and $4.0 million in general and administrative expenses, further strained the company's finances. Despite these challenges, CV Holdings saw a slight increase in unrestricted cash, ending 2024 with $2.69 million compared to $2.54 million in 2023. The company's main cash flow is derived from interest and income on equipment finance contracts managed by its subsidiary, Centra Funding LLC. A critical issue facing CV Holdings is its inability to redeem its senior non-convertible preferred stock, originally due in June 2020, with a liquidation preference of approximately $129 million. This obligation has been deferred multiple times, with the next potential deadline set for June 30, 2025. Colborne Brighton, LLC, the sole holder of this preferred stock, holds significant influence over CV Holdings, owning about 50.1% of its common stock, and potentially increasing this to 65% through conversion of its preferred shares. The ongoing deferral of redemption obligations and Colborne's potential to demand redemption or pursue other remedies pose substantial risks to CV Holdings' operational continuity and shareholder equity. The company's financial struggles and dependency on Colborne's forbearance suggest a highly speculative investment scenario, with potential investors advised to consider the high-risk profile and ownership restrictions outlined in the company's charter.